I'm Matt McCall. Welcome to Making Money. It is April 27th, 2023. We have a great guest coming up for you. Mike McGlone, Senior Macro Strategist at Bloomberg Intelligence. We're going to dive into a lot of topics. We're going to dive into that hot topic that is gold, trading right near a high. We're going to talk about Bitcoin. We're going to talk about the markets, where he thinks they're going to go. You may be a bit surprised where he thinks they're going to go in the near term and in the long term. And of course, his favorite investment for the next 10 years. It's a basket of assets that you maybe like to hear that he likes them so much. And he actually agrees with me. All that and more coming up right now on Making Money. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market and potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. All right, folks. So here we are. As I mentioned, we're going to talk a little bit about commodities today. And, our guest, very well known in the space. He's a macro strategist. But Mike, thanks for joining us for the first time here on Making Money.
Thank you, Matt. I love that. Making Money with Matt McCall. There's a lot of M's there from Mike McGlone.
I know we the whole show is all about M's today. And I don't know any commodities that start with an M. There's a rare earth metal out there, but we'll stick to the big names. Yeah. So let's jump into this. And, a topic that I have on the show a lot, Mike, is gold. And I've been a naysayer of gold for the most part of my career. When I managed money for 17 years, I had a span back in 2006 or 2009, somewhere around there. It was my largest holding. But for the most part, I've been negative against it. And I've been wrong the last year. Obviously, gold's been doing very well. I would love to get your view on gold right now, sitting around that $2,000 level, that psychological resistance level, and where you think it can go from here.
Up. I think it's just a matter of time. It pops to 3,000. Just needs a good catalyst. And first, I want to congratulate you on being underweight gold for the last being a naysayer. The last 10 years, gold has not performed very well. It's basically, just starting to tick up to be up on a 10-year basis. And the key thing that I think has really pressured it is changing, and that is the U.S. stock market outperforming the rest of the world stock markets by a wide margin. I mean, to me, that chart, when you measure the U.S. stock market versus like the MSCI ex-U.S., it kind of looks like the stock market in 1929. But there's no reason to be long gold in an environment when you're a boomer or whatever, and these boomer rocks aren't moving, but the stock market's giving you annualized 8 to 10%. To me, that's what's changing. And you did mention gold is right now on a 12-month basis is probably the top performing major asset, notably compared to Bloomberg Commodity Index is down 20%, and certainly compared to the stock market. So the key thing is, I think that's just getting started, that acceleration where gold is people are going to have to FOMO into it, and central banks, the deepest pockets in the planet, are already doing that.
So is this a story about the U.S. dollar? Is that a big driver of your thought process behind that the dollar will weaken and help accelerate gold higher from here?
Less so the dollar. I think the dollar is due for a pullback. The key thing to remember about the dollar, when you measure the dollar versus a basket of fiat currencies using the Federal Reserve's trade weight rated dollar index, it goes up over time. The only time it goes down is after it goes up a lot. Well, last year it went up a lot. So it's in a pullback mode. Fed pivot might be bad for the dollar. But the fact that the euro made gold made new highs in terms of the euro, and made new highs in terms of the yen last year because of dollar strength. But to me, it's more just an outright gold thing. But I think, you have to look at it as a bit of a reciprocal to the dollar. But I'm not so bearish in the dollar overall. It's just this asset gold I see as it's just a bull market waiting for a catalyst. It's getting it. It's that 2,000 level is just hurting people. I think what it's waiting on is that Fed pivot. And the key thing I think that's really going to kick in for gold to be an enduring bull market, just pop up to the next key resistance, round number resistance around $3,000, will be when people start realizing that we are in a elongated bear market than U.S. stock market. So get that S&P 500 to start ticking below 4,000 and start doing what it normally does in recession, and gold what it normally does in a new U.S. recession, and bonds what they normally do in U.S. recessions. I mean, bond yields going down, stock market going down, and gold is just so ready to take off. And I look at this as my key question I like to ask, Matt, is what stops this current trajectory from accelerating? And the fact that the Fed's still tightening, I think, is they're going too far. They're pushing the market to serious deflation, and I can point that out with certainly with commodities, which is going to spark the gold FOMO to just take that 2 handle and switch it to a 3.
So your catalyst, and if I'm reading into this and I'm wrong, let me know. It sounds as if stocks will be continued to drift lower. Then obviously it makes gold more attractive, because you just asked what would kind of keep gold from going to the 3 handle, 3,000, and I think that would be obviously a bull stock market, right? Because if the stock market's doing well, you're not going to sit in gold. You're going to see the FOMO go back into stocks. I mean, what do we have? 5.2 trillion in money markets right now, something give or take around there. Yeah. That money, isn't that money going to go somewhere at some point, Mike? And is that going to be into bonds? Is it going to be into equities, or is it going to be somewhere like gold, where that people are looking for that safety, I guess, outside of everything else?
Yeah, I think that's a good point, all the above. So to what could stop this is, yes, if the stock bull market, which is a consensus that the stock bull market is over, or the bear market, the correction is over, and just going to go back to that elongated uptrend, that could hurt gold. I'm very bearish the stock market. I fully think what's around 4,000 in the S&P 500 is just going to go to 3,000. Not a big deal, not a profound statement to make in a normal recessionary environment. But I think it's those, the other things that are significant that should matter. It's the macro that I think is going to be most significant, and that is when people look. You got to mention the stock market, I think, because that is the main competitor for gold for the last decade that you mentioned. And I think when people make these statements, which we had a great conversation with our chief economist Anna Wong yesterday, and they fully agree that most of the correction, the stock market's over and it's normal. They're missing from where it came. And that is before the Fed started tightening in March of last year. The U.S. stock market was the highest ever, as I mentioned, versus the rest of the world's equity markets, MSCI ex-US. It was the highest ever versus GDP. It was the highest ever versus housing, which is going down rapidly. It was the highest ever versus sales. So to me, this is a normal, way overdue, autocorrelated move in the U.S. stock market that's going to make it underperform for maybe 5-10 years. That's typically what it happens, and that is what we're tilting towards now. The significant recession that's signaled by the yield curve. And the key thing I've been using is fossil fuel deflation is fueling gold inflation. And you can see that in things like U.S. natural gas. It's a fossil fuel. It's the number one measure of heat, electricity, and fertilizer, which gives us food in the world. And it's dropped to the same price when it first traded in 1990. Now, just imagine we said that about the stock market. So that's serious deflation from commodities. And it's that deflation that I think we're kicking into an elongated recession, deflationary recession, which is just normal after the biggest pump in liquidity ever that's dumping, that will fuel the gold price. So yes, the key thing to make me wrong about gold, I think, is if I'm wrong and by the end of the year the S&P 500's here or higher, I think by the end of the year it's going to be knocking on a 3 handle on the S&P 500.
So to play devil's advocate here, if we do have deflation in some of these commodities, we continue to see inflation come down. I mean, we have CPI, obviously, has been kind of falling off a cliff, down to 5% last month. PPI down, I think, 2.7%. And, the month-over-month numbers are going to lead us likely to see CPI 3.5% in the next couple of months, if not sooner. And that could lead to the Fed. I think the Fed shouldn't raise anymore, but it could lead to them stopping after maybe one more rate hike at the next meeting, 25 basis points. Historically, when the Fed stops and we have inflation coming down, and if we do have that deflationary pressure from commodities, Mike, would that then lead to the Fed at some point by the end of the year in early 2024 start cutting rates, then accelerating that FOMO back in the stocks?
So that's what the market's priced for already. I mean, you look in the Fed funds futures on the Bloomberg, I just type in the WRP function, And it's supposed to go, rates are supposed to be, they're going to raise 25 at the next meeting, unless the stock market collapses before next May 3rd. And then they're going to drop to by end of 23 to 4.3% or so. So it's priced in the market. It's the key thing you mentioned that it's never happened before, and I'm going to be presenting to Miami-Dade college students tomorrow. My headline is, here's stuff that's never happened. The producer price index, for 75 years of data, it's never dropped at the velocity it has in the last 9 months. It's down from around 18 to 3. That's 15%. That's much more than the last big plunge, which is the financial crisis, which trowed around minus 6.9% in July of 2009. By the time we get to July 13th is when we print the June PPI index. It's going to be printing negative in my view. And that's just not profound. It's a fact based on the producer price index is basically about a 2 beta to CPI. And it's mostly driven, PPI is mostly driven by commodities. Right now, the Bloomberg Commodity Index is down to about 21%. Natural gas is down 80%. Unless these things go back up by the time we get to next, the July, when you measure the June number, which was the peak last year, we're going to have significant deflation. The key thing is, from a Fed standpoint, they're focused on two key things: employment cost index and personal consumption expenditures, and CPI, ex food and energy. A lot of that's owner's equivalent rent. They're very sticky. They're high. They're above their target. And as my colleague I mentioned, our chief economist Anna Wong pointed out, these things are going to stay sticky. So that's the human nature. That's the lose-lose situation. The Fed is still tightening. They might stop at this meeting, but remember, it's only been a year since the first hike. We have long and variable lags just starting to kick in the market. They're so far behind their numbers, they think they're ahead of the curve, but they're so far behind what markets are pricing in. So here's one good example. Why is the 10-year note yield at 3.4% and the Fed funds about 5%? Because that's the yield curve pricing in for that recession. So I look at it as it's consensus. I got to meet David Altig last week. He's the head of the Atlantic Fed. I had a good 10-minute conversation with him. I really enjoyed him. When I pointed out my recent article, which headlined, "Has the Fed Gone Too Far?" and I pointed out plunging PPI. Now, PPI is it's the high beta of inflation measure. But again, it's just the measure. Markets are markets, and they're pointing to that. When I pointed it out to him, he said, there is some people at the Fed who agree with you. But the key thing that struck me from his statements and his conversation was when he pointed out is we felt like we handled the macro well by sticking with our goal to reduce inflation by hiking rates at the last meeting, despite the credit crunch. Now, you mentioned the money markets. We have the most significant outflows of U.S. bank deposits ever. So that is classic bank credit crunch. And as Ben Bernanke pointed out in his essays on the Great Depression, is the number one thing we learned from the Great Depression is when we had contraction money supply on a global basis. Now, we are clearly having the most contracted money supply in our measures since 1962. Now, obviously, it pumped too much and it's dumping. So to me, that's the current trajectory. And I think the bond markets figured out. The commodity markets have clearly figured it out that we're heading to a severe recession, despite this consensus that China demand is going to keep it up. So I keep asking myself this. I think we're heading towards one of the biggest resets of our lifetimes in terms of markets, and that's just studying pumps and dumps liquidity. Gold's in the center. And the key thing I ask myself every day, Matt, is I started saying this a year ago, is what stops this? And every day that goes by with this, we're seeing in the bank crisis, are just those kind of things. They're trees in the forest. And the forest is we are just on the back end now of the most aggressive Fed tightening ever, if you do it on a log normal basis from zero, and the most aggressive global central bank tightening ever. The long and variable lags have barely started. So to me, for the stock market to come out of this, at some point we have to have a long and variable lag from a period of easing. And the key difference from the past, when people say, "Oh, when they stop hiking, we'll do better." Remember, I was trading treasuries in '94 during that huge hike cycle, and that worked very well. Once we were done, the market did well. The big difference is the plateau we're coming from, which is what I had to start out with. Is we're coming from the most expensive stock market ever, relative to the rest of the world, relative to housing, and relative to GDP. That is the mean reversion risks I think are just tweaking. And I'll end with this: the key thing that's also different is the boomers. The average 70 age, the crypto people like to call boomer rocks for gold, refer to gold as boomer rocks because boomers seem to like gold, is they have a lot of incentive, I think, to buy 2-year notes when they're at 5%, which was happened in March for a while. The bank crisis kicked in, and they still have a lot of incentive to buy 2-year notes at 4%. Now we're getting right at the screens right now, 389. I think they're going to just keep squashing yields, and the stock market's going to follow.
Gotcha. So you talked about recession a few times. You mentioned the R word, and one metal that I've read a lot of your recent stuff is copper. Copper, this is a topic we vary on. Gold, I'm agnostic. I can listen to both sides and not really get too worried about it. Copper, I am bullish on copper, and I read in your most recent here you talked about copper's around $4 a pound, give or take. That you think we see a 3 handle before we see a 5 handle. That's the next line of least resistance down to 3. Why don't you explain a little bit why you think that could happen, Mike?
So I think copper, I don't think it, here's the facts of copper. It's very highly correlated to the stock market, more so than ever. And if you take the dollar price of copper at $3.86 at the moment, and overlay it with the S&P 500, just divide by 1,000 S&P 500. They're like the same price since 2015. Mm-hmm. So here's the key thing: copper, Dr. Copper, the metal known to PhD in economics, I think is going to have a big problem as the stock market goes down. Again, this is part of my base case. The stock market's going to just have an elongated, normal bear market for recession. Copper gets pulled down with that, or is copper leading? Right now, it's leading a little bit. So to me, that's the macro. And it's also yields. When yields drop, it's that copper gold ratio. So one thing I really like is watching the gold copper ratio. It's just starting to tick back up again. And it typically makes that ratio in the last 2 recessions, it makes new highs. So that's, to me, is a problem with copper. It's macroeconomic. Now, here's a key fact about copper. Last year, it made a new high, all-time high. Crude oil didn't. To me, that's telling. In the big picture, I fully expect copper to continue to migrate higher in the over long term, and maybe eventually get above 5, but it might be a few years. I'm pretty certain that, I'm not certain, but my view is it's going to break down just like with all risk assets and go towards 3 with the U.S. recession. And the key thing about a U.S. recession is you look at the yield curve, it's the highest probably since 1982. And another key fact is, as David Alteg said in his meeting last week, it was at the at Miami-Dade College, is it's the stated goal to increase unemployment. And there's never been a case of unemployment going up from the lowest level in 50 years, or a very low trial like this, without a recession. The key fact is everybody's assumed, even he said it, and the Fed assumes, we're going to have a soft landing. To me, that's very, very optimistic, and that's where the optionality comes in. The market's jumped in and priced for that soft landing. Why is the S&P 500, at the time we're speaking, up about 6% in the year? Why is it bounced from last year? It's because the market says, okay, the Fed's going to stop tightening, we're going to start easing, we're heading for that soft landing, everything's good. That's where the optionality comes in. I look at it as an ex-trader. I don't trade anymore, I just say it. If I'm running money, I'm looking at doing, at least protecting myself, or saying, okay, well, we've already priced for some of that soft landing. The big optionality comes in. We can maybe like get 10x on a properly positioned option position, is going back, just setting up positions to play for a continuation of the bear market. Now, Goldman Sachs put out a piece about that a little while ago. I think that's what's been happening. I remember seeing this happen in 07 and 08. Markets just get too short. It bounces, and finally goes down. And I think we're at that stage now. We're going to start tilting over and go back to a real bear market. It was going to drag all risk assets lower, with the exception, and gold is a risk-off asset, and U.S. Treasury bonds. So I think that trend in gold outperforming most assets on a 12-month basis is going to accelerate, and the U.S. Treasury bonds outperforming is going to accelerate.
Yeah, I mean, your case for copper going lower based off everything else you said makes perfect sense to me. I mean, that it all adds up. And I one thing you said, which I did like to hear, is your longer term basis on copper is that it could see 5 or potentially break 5 years from now, because any study I look at from all different research firms, looking at the long-term demand for copper based off expansion of renewable energy, EVs use 2 to 3 times as much copper. I mean, copper is needed for basically the transition of the energy industry to the next generation, in my opinion. I think we all can kind of agree with that. And you're not seeing as much copper come online that's going to be needed. And most firms will say there's going to be a deficit at some point between late 2020s, 2030, there will be an annual deficit for copper, which supply demand leads me to believe that copper would be higher then. I do agree with you, though. I think in the near term, copper is going to be very choppy. And we recently recommended a copper play a couple of weeks ago. And we said that. They said this is a 5 to 10 year play. This is not, in the short term, I don't know where copper is going to be. And nobody knows. But do you think at some point, do you agree with my thesis that there will be a supply demand issue at some point? As even if we have a bear market now, at some point, 2028 to 2023, or 2033, there will be a copper bull market at some point.
Oh, sure. Well, electrification, decarbonization, digitalization, all that stuff is obviously very bullish for, Dr. Copper. Yeah. But what we are discussing are very much widely known knowns. I'm bullish copper in a big picture. To me, it's also very much constrained supply type metal. I mean, comes from somewhat dicey sources in South America. All you need is one of the few political issues here. Really get a sense for that in Miami. That's why people here, part of the reason I love cryptos. Like the bullish fact. I like the fact that copper made a new high last year and crude oil didn't. And I love that ratio, long copper, short crude oil. And particularly if you're using actual rolling futures, because typically you hardly ever have to worry about copper's easy to store, but futures are a little bit backweighted now in WTI, but typically they'll go back to contango, which means you get that oomph like you do in natural gas right now. But yeah, big picture, bullish copper. But the key thing to remember about copper is when you talk about commodities with a decent negative correlation to the US dollar, gold's one, copper's number two, basically, macro. So if you're bearish US dollar, copper's typically a good place to be. But also the key thing in copper is China. And I'm quite bearish on the bullish prospects from Chinese commodity demand. Now, I've been saying that for 5 years. I've been pointing out the incremental demand, and it's what's happening politically now is this major divestment out of China. It's happening at almost a greater pace than the investment in China happening. It's significant, and the political inklings where it's become it's not China anymore. It's Mr. Z autocratic rule. It's not going to succeed. It typically never does. So to me, that's out. Maybe we'll get the the demand from India, but China, I think, is already basically done from the copper demand standpoint. So this, to me, is the big picture right now. The macro is most risk assets declining with the U.S. stock market. And if I'm wrong, we'll revisit that one. And copper is a good leading indicator. The fact that it's broken down below 4, it's been stuck at 4 for months, and that S&P 500 is still stuck at 4. I just take the S&P 500, divide by 1,000, basically at the same price of copper. Kind of just watching that. And the key fact I look at is, I'll end with this. The Federal Reserve is still tightening with the U.S., the world's largest demand pull economy, heading towards recession. Why would it seems illogical to be looking to buy rallies and risk assets who typically should be looking to sell rips and buy dips. Actually sell rips and give up on the dips.
That's excellent insight. You mentioned Miami, you mentioned digital assets, Bitcoin. Bitcoin's been on a hell of a ride, recently. When it broke above that 28 and change level, above almost 31, I thought that was the takeoff. Last couple of days, we came back down to 27 and change, and now we're close to 30 again. It's been all over the place the last couple of days. What is your view on digital assets, aka Bitcoin?
Bitcoin, Ethereum, and Bloomberg Galaxy Crypto Index, I'm fully very bullish in the big picture, but very concerned about the macro ebbing tide of what I see potentially a bear market in stocks. So I view Bitcoin as global digital collateral in the world going that way, and every single risk manager on the planet, every day that goes by, they all know I have to have a piece of this. And I think what's happening lately with Bitcoin running up around almost back up to now 30,000 with the stock market breaking down, it's hitting to that inflection point that I've been waiting for a while, and I'm quite impressed that Bitcoin is going to be starting to trade more like a risk-off assets. But cryptos are still the riskiest assets on the planet. They're fastest horse in the race, and Bitcoin's just the least risky. So I'm a bit stuck in the middle on Bitcoin. On big picture, I don't see anybody who's allocating to anything about gold anymore has to have some Bitcoin in that space. I fully believe what Saifedean Ahmed said in his book, The Bitcoin Standard, that central banks will eventually hold Bitcoin. But it's that near-term issue I'm worried about. If I'm right that stock market breaks down for a normal recession, it's going to pull down all risk assets. But what we're seeing lately is great. Is looking at like the bank indices breaking down and Bitcoin breaking back up. That's a cool indication of where I think we're going. People are realizing that this digital asset that when I first heard about it, I thought it was silly internet money, is becoming global collateral. And I fully expect that to happen in the long term, but I'm still really worried about the ebbing tide. So I've got to lose my bearishness in the stock market and or see more what's happening where stocks break down and Bitcoin's inching higher. This divergent strength is just what I was expecting. It's just I'm still worried about a rug pull in the stock market. I mean, I fully expect a 20% drop in the S&P 500. And if I expect that, I expect crypto assets to suffer. So here's a key difference I like to point out. Bitcoin digital gold is going to do better. It should continue outperforming most. I mean, there's 23,000 cryptos, so there's way too much speculation in that space. Ethereum is making happen what I think I find institutions still don't understand. It's not crypto, and even especially our regulators, some of them get them, some don't, that the most widely traded cryptos are not Bitcoin and Ethereum, it's crypto dollars. Tether's one, and there's a dozen other ones made possible by Ethereum, makes possible NFTs, makes possible tokenization. So this technology is, to me, it's as revolutionary as futures were 50 years ago, as ETFs were 40 years ago, and it's just a matter of time. But like I said, they're so new, and you got to expect the volatility. But I'm afraid Bitcoin might have pressure below 20, around 20, and at some point it's going to get above 100. I just got to see how we get through this rug pull in the stock market.
So, Mike, this morning I was reading, and again, you read in the morning, and sometimes these numbers get all messed up in my head. But I was reading about what portion software stocks make up the S&P 500, and even if you take out Microsoft, I think it was a very high number. I don't want to butcher a number and put it out there, but it was a super high number. And I view Ethereum, and this is, I think other people agree with this, but, it's just an opinion, that Ethereum to me is basically, one of the best investments the last 30 plus years has been investing in software companies. And to me, Ethereum is kind of the backbone of that next iteration of software. And it's going to drive, and people, as you mentioned, so many things are driven on the Ethereum platform. And that's why I like it. And, my personal money's majority of it in digital assets are Bitcoin, Ethereum, a little heavier in Bitcoin, but for other reasons for that. But yeah, I tend to agree with you, talking about that. And the other thing you talk about, and is kind of the correlation, a couple of years ago, or about a year and a half ago, you looked at the correlation between the Nasdaq and you looked at correlation in Bitcoin. I mean, it was kind of moving hand in hand. And that's really kind of widened a bit. It's not as correlated this year alone. I think, and you mentioned this, that if I start seeing the market go down, stock market, and Bitcoin holding up better, that is the biggest positive I'm going to see for the long term of Bitcoin, in my opinion.
Yeah, great. That's what's been happening lately. I mean, particularly when the bank index broke down hard. So I love overlaying that chart. If you go back to since 2019, KBW bank index is overlaid with Bitcoin. It's almost exactly the same. Banks break down, they're banking down harder. Bitcoin banking up. Bank crisis, might as well go to something that might be safer. I completely agree with that scenario. It's happening. It's happening in front of our eyes. So I guess I'm like, whoa, is this really starting to do it? But the way I look at it is there's so many good indications. Like you mentioned Nasdaq. I love looking at, if you overlay Bitcoin with any risk asset, even commodities, everything over the last 5-10 years, you get that standard outperformance, Bitcoin beating everything. But what's significant is the falling volatility. Bitcoin volatility versus the Nasdaq, you use annualized just a few years ago, peaked around 10%. Now it's only 2 to 3 times the Nasdaq. Bitcoin volatility is running around 60% annualized. That's about where Amazon was much higher than that in 2000 when Lehman put out a bad report and Lehman ended up going under. It's not too much higher than where gold was in 1980, and it's clearly heading lower. So to me, it's that maturation. And one thing I think that's most significant I want to really end with is what it's been doing. So our regulators are pushing back in the short term, and they're understandable. I mean, what happened with FTX and Sam Bankman-Fried. But if you look at Bitcoin futures open interest. Now that's pure adult markets. It was on the few, and this is CME listed, it's a bull market, clearly a bull market. It's one of the few markets I pointed out last year. We're seeing more and more interest. It's squashing the cash and carry, squashing the volatility. The hedge funds are getting in there in a big way because there's money to make, and it's just making it much more of an adult asset. I ask myself, what stops this? So the way I look at cryptos is I don't see us having a significant plateau in that space until you and I, your average person, can push a button and buy a widely tracked ETF that tracks an index of actual cryptos, like we can SPYs and Qs and all that stuff. It's, to me, a matter of time. And you're doing it in other countries. I mean, you certainly can do it in Canada and in Switzerland and Australia, in some other countries. But I was in Bermuda recently. Man, they're so positive on cryptos. I mean, I heard Coinbase might be opening up there. So that the macro is so good in big picture, and that's just why I'm afraid. Very impressive to see running up around 30,000. Can't get bearish. I'm just worried about, like I said, if I'm right about equities. What's happening already is great. What I'm seeing today, now we're recording on Thursday, Wednesday, and it seems like there's pretty significant asset allocation going on. You're seeing money coming into precious metals, gold, definitely getting out of most commodities. Equities kind of getting definitely out of the banks into money markets and coming into cryptos, coming into Bitcoin and Ethereum.
You know, not to labor the Bitcoin discussion here, but you know, for the last couple of years, I've given a lot of speeches to financial advisors. I own a financial advisory firm for years, and speaking to them about specifically investing in digital assets, Bitcoin. And you know, people running billions of dollars, and a lot of them have no clue what Bitcoin is. They have no clue how to gain exposure to it. But one thing I found, Mike, was almost 95% of the time of the people sitting in a room, they've had their clients basically knocking at their door for the last couple of years, get me exposure to Bitcoin. And they have to do that or they're going to lose their clients. They're going to go somewhere else.
Yeah.
And if that trend continues, that along with obviously big institutional money, you don't need that much more. Supply demand tells me that's going to push Bitcoin up over the long term. Again, if you're correct with the bear market, I believe Bitcoin would pull down with it. I 100% agree. I'm looking at longer term. I think that's going to be one of the biggest catalysts on top of some good regulation here in the States. Hopefully that is good for the industry. That combined, those two things combined, man, it's tough to stop it from there.
There you go. So what you stated was my exact same observation working at Bloomberg. I would get, I don't get the, I used to be with clients anymore, but I get the questions. And for the last 4 years, I'm getting the same questions from the major institutions on the planet. Mike, what's this Bitcoin stuff? We need to know about it because our clients are asking about it. And that's from some of the biggest banks in the country, in the world, asking the same question. So I like to point out that I've never seen this in any major asset. We have definable diminishing supply by code. Obviously, we get to the halving next year, right around the election. We're getting below the election. So you have that. And same thing in Ethereum. It's with the upgrade last year, we have definable diminishing supply. And increasing very early, low, and increasing demand and adoption by code. I mean, by rules of economics, price must go up over time. It's just a question of working through that volatility. So I completely agree with that. But we've all had similar observation. It's just how do I get exposure to it? And the sense I'm getting now is most people now are very much educated about what it is, where it's going, and what it's doing. And I'll end with this. One good example. I'll give you an example of anecdotal what's happening in this space. I moved to Miami almost 2 years ago. I did the commute from Connecticut forever. And one of my good friends, Wall Street guy, lived in Connecticut, now took a job. He took a job with MasterCard, one of the big ones, as head of crypto for LATAM. That position did not exist 2 years ago. So when they get the big Visas and MasterCards in the space, and they point out that, I can square up my dollar balances, liabilities, or assets instantly for virtually no cost through crypto dollars or stable coins. I don't have to wait the weekends or the 4 days a week for all the banks to be open. It's just, you can't stop that technology. It just might be pushed back in the short term.
Yep. Well, before I let you go, Mike, I ask every guest what I call the island question, and you can answer it any way you want. But if I were to send you, your family, your friends, whoever the hell you want to take with you, maybe to Bermuda, some island where you want to hang out for 10 years, what's the one asset class, the one investment that you feel very comfortable throwing your phone in the ocean and letting it go for 10 years?
10 years, it'd have to be an index of cryptos.
Okay.
And I wouldn't say just one of them, an index that properly tracks and measures it by, market cap basis or whatever. Have to be an index of cryptos. For 10 years, got to be that.
Well, I love that answer because I have a lot of my money there. So I really hope you're right, Mike. In 10 years, maybe I'll take a trip to the island if you're right when that happens. But hey, man, thank you so much for joining us. I love your stuff. I mean, I was reading it all morning. I have it printed out right here. Great insights as always. And we'd love to get you back on again soon.
Thank you, Matt Mick from Mike Mick.
Yep. Thanks. Have a great day, Mike.
Appreciate you having me.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.